Alrighty, what is going on, everyone? Happy Sunday. Hope we're all doing well. Appreciate you guys joining us here on this lovely Sunday. Make sure the audio is all good here on my end. Alrighty, what is going on, everyone? All right, should be good to go. We're ready to rock and roll. Hope you guys are doing well. Hope you guys are having a restful, relaxing weekend and ready to get back to business here this week. So we're here with the weekly forecast for December 8th, 2024. So what I'll be looking at today, usual business for the newer folks, we'll be looking at the US dollar, confirming the US dollar with the treasuries, then from there transitioning into index futures. And then after, as always, I will make some time to do Q&A and take your guys' lovely questions. If you have any markets you want me to take a look at, would be more than happy to do that as well. So with that, guys, thanks for joining us here. Unicorn Queen, hello, hello. Cyclops, my man. Yes, sir, we are doing great. Hope you are as well. Michael, hello, hello. Eslam, welcome back, Dylan. Glad to be back. Glad to be back. Matthew, not much till CPI. Patience will pay this week. Yes, sir. Yes, sir. The good thing is with what we do, every day the market's running the highs and lows at time of day, right? So we still have intraday session scalping opportunities, but absolutely the bigger, cleaner price runs are obviously going to be on the other side of CPI and PPI. So we'll be saving most of my gunpowder for those days. However, we'll see what we get Monday going into Tuesday. All right, so with that, guys, let's get right down to the business here. So again, weekly forecast, December 8th, 2024. So the economic calendar for this week, as my man Matthew is bringing up, we have CPI Wednesday and PPI on Thursday. Relatively light week on the economic calendar side, and much of that is because we are in December, slower trading months, however, still opportunity. So we have Monday, Tuesday, no news, and then Wednesday, Thursday, we have the higher impact news. So the better trading will likely occur Wednesday, Thursday, going into Friday. However, as I was just mentioning, there's still opportunities day to day if you know what you're looking for, but you absolutely have to be careful on days where there's no news because the market can easily transition into high resistance, difficult price action, especially the day before CPI, right? And if you're not already subscribed to our newsletter, I do recommend you do that, where myself, my team share how we're attacking each week with precision, right? Like, for example, if you look at the previous week, Thursday before NFP, absolutely brutal. However, it was predictable. So if you're looking at your trade data, you're reflecting on your results, and you're trading difficult days, and you're not tapped into the resource that we make available with the news, with the economic calendar and the news and how we structure our trading around that, you're definitely missing out. So definitely recommend you tuning into that. Humble Investment, welcome back to the office. Yeah, glad to be here. Long drive. All right, so the assets we're going to be looking at today is the US dollar. As always, then confirming that with Treasury bonds, and from there going into stock index futures. Before I get the question, I know usually I get it. Can you take a look at euro? Can you take a look at pound? It's just going to be the inverse of the US dollar. However, one of the things you do want to be mindful of with trading euro or pound is one of those two assets will give you either cleaner long setups or cleaner short setups. So you do want to do what's called a relative strength analysis on those two assets to see whether or not you're trading pound or euro. For example, look at the past 3 to 5 weeks, 3 to 6 weeks on the US dollar. It's been doing what? Going higher. Euro and pound have both been dropping, which is obviously what we expect, but which one was dropping more? Euro was dropping significantly harder than the pound. So you want to short the weaker asset, and that's something that you can easily determine with something that I call relative strength analysis when you're measuring two different asset classes that move in similar direction. So if you guys have any questions on that, follow up in the Q&A, and I'll be sure to cover what is relative strength analysis and how we do it in a simple, straightforward way. All right, with that, guys, let's get into the intermarket analysis here for today. Reaper, hello, hello. All right, so for the US dollar, starting here from the weekly chart, taking it from the top. The weekly fair value gap that we're trading in right now, which is this one here, will confirm if we remain bullish long term. Very straightforward. If we're going to continue higher longer term, then we will expect the market to find support inside this weekly fair value gap. I will be using the treasuries to confirm or invalidate my bias in the US dollar. right? We've called a monster move higher from this reversal here into these relatively equal highs here, 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 and then into that weekly fair value gap. After reaching several targets on the upside, it's reasonable to see the market retrace, right? We've retraced down to the weekly fair value gap. One thing I am watching is if you notice that dashed line there, that is the 50% or the midpoint of that weekly fair value gap, right? We do see the bodies respecting that. So if the bodies stay in the upper portion and we fail to get down to the low end of that fair value gap, that will indicate bullishness going forward. However, if we slip through that weekly fair value gap, then we have this weekly fair value gap below as the discount target and lower prices. Again, you will be able to confirm that with the treasuries or the bond market. Moving right along into the daily chart. So the market traded down to a discount of the dealing range and to monitoring to see if we get institutional sponsorship at these levels. Let's take it from the top. All right, the dealing range, this high to this low. Why this low? This low here takes out sell side. This high here takes out buy side, creates a swing high, and we pull back into the range. So the dealing range is this high to this low. We've just traded down to equilibrium or a discount market. Create a swing low, take out the sell stops in a discount. And now what I want to see is, do we get institutional sponsorship? And again, that is just a fancy way of saying, do we get displacement away from these key discount levels where institutional buying would occur? If we trade through the weekly fair value gap, this will confirm weakness for the dollar moving forward, right? So again, that weekly fair value gap, which is here, just showing that same range here on the daily chart. If we trade down through that, again, that indicates weakness. And then I will have to pivot and look for lower prices on the US dollar. For targets on the upside, if this does create an intermediate term low longer term, we have these smooth highs here. We have the rejection block here where you see these smooth bodies. And then we have this high over here at the, call it the 108 level, if we remain bullish long term for dollar, right? But we would have to see a displacement away from discount valuation. Moving right along to the hourly time frame. So we had the sell side taken in a discount, then displaced away from, right? You got to keep in mind top down. So as we go into the hourly chart, we're zooming into this price action here. But we need to keep in mind the context of that price action on the higher time frame, right? That's how you avoid pattern trading and looking for things in lower time frames that don't make sense top down, right? So again, keep in mind what we're looking at as we zoom into the lower time frame. So we're inside the weekly fair value gap and in a discount of this dealing range. So hourly time frame, again, the sell side taken in a discount here, right? So we have this low here, which was the previous weekly low. We trade down through it, and then we displaced away from it on Friday. So if we are to remain bullish, this intermediate term low down here should not be violated. Why is that an intermediate term low? Because it dropped down, took out the previous week's low, traded to the lower portion of that weekly fair value gap, and quickly displaced out of it. When we're bullish, we don't want to see the market spend a lot of time in the lower portion of a fair value gap. We want to see it trade down into it, leave it aggressively, energetically, which will confirm bullishness long term. So this swing high here violated after the run on stops. That's your market structure shift. So if we are to remain bullish, we'd want to see this be a key low and see us expand to this buy side here, here, and ultimately these equal highs if we are going to remain bullish. All right, moving right along to Treasury bonds. So we are trading inside of a monthly fair value gap, and how we trade there will be important going forward for macro perspective. Macro perspective meaning long term. So we have this monthly fair value gap. We've now traded into it for the December monthly candle, and how we trade there will be influential longer term for treasuries. Weekly time frame. I'm watching treasuries to confirm or invalidate, again, my bias in dollar. So what I'm looking at is the range that we're trading in treasuries. We have this high here, this low, we have equilibrium. So as long as we continue bullish, we'll be aiming for equilibrium and any PD arrays that are just above equilibrium. And if we see strength in treasuries, then that will likely confirm weakness for dollar. However, if we start to see treasuries trade lower, then that would confirm higher US dollar. Daily chart, institutional order flow on the daily chart will give me near-term direction, right? So what do I mean by that? I'm going to let the institutional order flow on the daily chart confirm what I'm looking at near term, meaning right now we're trading inside this daily fair value gap here, which we then closed above and used as support and expanding higher. So what does that tell you as someone that knows how to read order flow? The market's bullish, right? Same thing here, down close candle, supporting price, down close candle, supporting price. And now we have this daily imbalance above, right? So that remains the draw short term. But what do I mean by we need to monitor order flow? Well, then what happens once we get to this fair value gap here, right? Do we hit it, displace away and reject and break down? That would indicate bearish order flow, right? What happens if we trade to it, through it, close above it, and then do something like we did here, right? Trade above it, use it as support, and start to expand higher off that. That would confirm bullishness, right? So very basic understanding of institutional order flow, and you can use that to get near-term targets and where the market should draw into, right? So as long as down close candles are supporting price, we're trading to and through these key premium levels on the left side of the curve, then that will confirm that the market is still going to continue higher. But if we hit these key premium levels and then we sharply break down, then again, that's going to indicate something entirely different to you. All right, transitioning over to the NASDAQ. So the December monthly candle is bullish, looking for open low, high close on the monthly candlestick. Well, you're probably thinking, well, doesn't every candle have an open, high, low, and a close? Yes, but what this does is it gives us a framework for what we're looking for in a candlestick, which is we expect an open, a low, and then after that we expect it to expand, make a high, and then close near that high. So that's going to be helpful for determining a weekly bias, right? I know I was not live on YouTube last Sunday. It was the weekend after Thanksgiving, and NFP week was the previous week. So I just did analysis in the Discord, which is free actually, by the way. So the free Discord actually got my weekly outlook last week, and I'll give you guys some insight as to what allowed me to see the market being higher and how I was able to give premium targets last week. If you look at this wick here on the monthly time frame, the month of November's candle did what? It closed, and it closed above 50%. Wicks are gaps. If we close above 50% of a gap, that's confirming strength and bullishness, and especially when the order flow is already bullish to begin with. So we close above the wick here, 50%. This candle open low and expecting distribution to the upside. So again, it's in the details where you get the precision. Weekly time frame. So market displacing away from the propulsion block and closing strongly above the weekly swing high, confirming bullishness. I am expecting another bullish week. Last week, I also took our attention to the propulsion block here. Why is this a propulsion candle? Because this is a bullish order block, these two consecutive down close candles, and this down close candle trades into it, right? So now we expect this candle to take the place of institutional support. Traded down into it once, twice, and then from there we started to expand away. So that's how I was able to predict this weekly candle being bullish, aiming for this swing high here on the weekly time frame. So there's the propulsion block. What I have in this dashed line here is this wick. I'm going to share with you guys some more precision elements for you guys to have in your back pocket. We see this wick 50%, right? Extending that through. If wicks are gaps and we're bullish, we don't want to see the lower end of a gap traded to, because that would tell us what the market is really bullish. So when we drop down, making the low of the week, notice it couldn't even get to 50% of that wick, which confirms what? Institutional order flow is extremely bullish. And you'll notice here I have a breakaway gap labeled. What I'm anchoring that rectangle to is the volume imbalance here. Breakaway gaps are not just fair value gaps. You can use liquidity voids, volume imbalances, and fair value gaps to gauge the strength of institutional order flow. So I can treat this volume imbalance here like a breakaway gap. Why is that significant? Well, because if we couldn't even trade down into that volume imbalance to fill it, what does that tell you about the underlying order flow? It's really bullish. It's in a hurry to expand higher. So this volume imbalance in and of itself is a breakaway gap, confirming what? Bullishness and strength. If we're trading, we want to see this in the direction we're trading. We want to see imbalances left open, and we want to see the market be unable to trade down into those levels, because what that'll confirm is, again, the market is in a hurry to expand higher. So just look at all the work we've done up to this point on the monthly and the weekly chart. This is why your 1 minute market structure shift shorts aren't working. So you have to understand top down. You have to understand what the market is reaching to on these monthly, weekly, and daily charts. Because if you lack that perspective or macro perspective, you're going to really struggle intraday trying to short every single retracement to the downside, right? And this is the skill set you need to avoid that top-down analysis. There's even a video I made on YouTube about it because I felt it was so important for you guys to know, right? So you always, always, always want to have emphasis on top-down in your analysis. And the reason behind that is funds, institutions, banks are all trading on monthly, weekly, daily charts. And then the last point here, this swing high, how did we close above that, right? Did we trade up to that high, reject it, and break down? No, right? It traded above it, strong close above it, indicating we're bullish, still looking for continuation to the upside. All right, daily chart. No, there's a lot going on here. I'll unpack it. Don't worry. Strong displacement away from the daily bullish order block. I'm referring to this one down here. I'll touch on this one here in a minute. This one here. Strong displacement away, confirming institutional sponsorship, right? So we dropped down into that bullish order block. When I was doing pre-market analysis, I believe 2 weeks ago, maybe 3 weeks ago, I wanted to see if this fair value gap could hold and send us lower. But the market ended up doing what? Showing support inside the bullish order block, trading above this fair value gap here and using it as an inversion. So those are all clues that tell you as a smart money trader that institutional order flow is actually bullish. So what I'm using here is fib projections for all-time high targets going forward. And again, we're trusting buy models until proven otherwise. So as long as we are at all-time highs, I'm not trying to call a top in this market. We're staying with the underlying institutional order flow until we get a significant break in structure or order flow obviously decisively confirms bearishness. So we had the daily bullish order block here, trading down into that, displacing away this fair value gap here. We closed above it, used it as support. That also made the low of the week last week. That's not random. So low of the week inside the inversion. First target that I gave last week was the rejection block, then midpoint of that wick, and then we had the all-time highs there. So what I'm looking for going into this coming week will be the 21,800 level. If we start to displace and show strength through the 21,800, I will be looking for the 22,200 level. How do I get those levels? What I'm measuring is the price leg from this low to this high, this low to this high, and I'm seeing where we get convergence. And convergence meaning where do we get overlapping standard deviations? Here we see there's a lot of overlap at this 800 level, and here we see relative overlap there at the 22,200 level. And they're also big figure numbers to aim for the upside as targets. Why am I looking higher? Look at how inside this daily inversion fair value gap we traded, made the low of the week there. And then what did we do from there? We displaced higher and we created 3 consecutive imbalances or buy side imbalance, sell side inefficiencies. When that's the case, that's indicating the market is extremely bullish to the upside. And then we saw on Friday, what did we get? Open low, making the low of the day inside the daily fair value gap. That's institutional order flow intraday. And then expanding higher, closing near the high of the day. So what I'm looking at now is this down close candle. If we're going to remain bullish, I want to see this act as a bullish order block. I would not want to see us get below this down close candle if we are to remain bullish. If we get through that down close, then we're likely going to see a much deeper retracement into this imbalance here, here, and potentially down here. So because this was institutional order flow entry drill, I want to see this act as a bullish order block, send us into that 21,800 level, and then from there we have the 22,200 level on the upside. So that's what I'm looking for on NASDAQ. Extremely bullish with all these signatures here, and we're looking for higher prices. Do not say, and this is something I want to emphasize because I don't want you guys going into the week and making mistakes like I used to make when I was trading all-time highs, where, man, this thing's already traded significantly higher. Man, it can't go any higher. Trust me. It can keep going higher, right? And it will rip your face off in the process. So you want to be careful of trying to short all-time highs. Stay with the order flow. As I always say, when the top is in, it's going to be in. It's going to show its hand. You don't have to force it. So keep trading buy models until the market gives you decisive confirmation that it's rotating lower. All right, moving right along, the hourly fair value gap will confirm if we continue bullish for this week. If we lose this level, then it could indicate a potential shift lower. However, for now, we trust buy models at all-time high. If you take anything away from this call here, it is trusting buy models at all-time high. Looking at NFP, we created a low here. This was an SMT divergence with the S&P. From there, we displaced higher, creating a fair value gap, trading down into it, leaving the lower portion open, indicating the market is still bullish to the upside. So as long as we remain bullish, I would want to see us stay above this hourly fair value gap. If we lose this level, then we'll look for these equal lows here and these lows here. However, I'm taking it candle by candle, day by day. Everything is bullish until proven otherwise, right? I'm not looking for sell side. Doesn't matter how juicy the equal lows look. The market will not attack equal lows if it's in a buy program. A buy program meaning the market's just being offered higher, 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 regardless of what happens. A perfect example is, let me go back to the daily chart. These equal lows here, right? These equal lows here and here. A lot of people are saying, well, man, it's so hard to go long here. I can't trust buying because of all these equal lows here. But you have to understand institutional order flow. If the market's in a buy program, it doesn't matter how good the equal lows look, it will keep repricing higher. So the same logic here, right? Don't say it has to go lower because there's equal lows. If order flow is bullish, the market will continue to be offered higher. However, if order flow confirms bearishness, we shift lower, then the technicals suggest that we could trade down into there, then that shifts the probabilities for it going lower, right? So it's just a matter of reading order flow, seeing what the market's giving you, and being able to pivot with all the new information that you get. So you put yourself at a huge advantage understanding how to read institutional order flow and understand how to predict what the next price run is going to be based off, well, institutional order flow and market structure. So with that, guys, that's everything I had for the PowerPoint. Do you guys have any questions for me before we get going here? Howie, not the 4-hour fair value gap? Yeah, good question. Let's go to the NASDAQ. So here you can see I have the hourly fair value gap. Yes, see that right here. There's the hourly fair value gap that I have highlighted. If you look at the 4-hour, there's nothing wrong with using this range here. It's just as you zoom into the time frames, you can refine a bit more. So if it does want to trade down into that 4-hour fair value gap, you'll notice the hourly fair value gap essentially shares the same range as the 4-hour. So neither one of them is wrong or right. It's just a matter of what levels you're using, what makes the most sense for what you're looking for, but they essentially share the same range. So what I'm getting at is you will reach the same conclusion regardless of whether you use the 4-hour or the hourly fair value gap. Because I'm intraday trading, I go more from a daily down to the hourly because the hourly shows a bit more precision than the 4-hour will, at least for intraday trading. So it's just a matter of what you're looking at. The 4-hour fair value gap isn't incorrect, just depends on your style. But they do share the same range, so you should reach the same conclusion. Like one thing, right on, was just curious. Thanks. Yeah. Awesome, Howie. Great. Yeah. Like for example, even myself and my team of analysts that have been trained by me for years, we don't always have the same PD arrays, but most of the time, I'd say in the high 80s, high 90% of the time, we're still coming to the same conclusion because we know what we're looking for. So let's say I'm looking at the hourly fair value gap, but my team's looking at the 4-hour, or maybe they're looking at a 15-minute fair value gap in here to refine it even further. Who's right? Who's wrong? Neither, because we're still able to come to the same conclusion with variations in the PD arrays. It's just a matter of what it is that you're looking for. Great question. Mr. Nuller, now I understand why ICC says the Dow is trash. This past week, price action was absolutely atrocious. I'm just going to focus on the NASDAQ now. I think that is a good call, Mr. Nuller. Good call, sir. Yeah. And I'm not laughing at the difficulty you had in the Dow. I'm just laughing because it's absolutely trash. It is absolutely garbage. Going to the Dow here. I mean, who in their right mind would want to trade a market like this when you have the sweet old NASDAQ? Yeah, Dow is trash. We have, looking at the Dow, we have equal lows, equal highs. I mean, just look at all the wicks back and forth, right? Just really difficult to catch sustained, easy price runs in this market, as opposed to something like NASDAQ, which is a lot cleaner, or the S&P, which is clean as well. Yeah, I think that's a good call. because with the Dow, it's only 30 stocks, whereas NASDAQ's 100 stocks, the S&P's 500 stocks. So it's going to be much cleaner price delivery in NASDAQ and S&P. And also considering that the 30 stocks that are in the Dow, they're not as significant as they used to be years ago. So there's a lot of factors as to why the Dow's pretty trash. Unicorn, can you review what a volume imbalance is? I use an indicator, but want to refresh myself on what exactly it is. You referenced it on the daily chart, I believe. Yeah, great question. Let's go to... Let's take off all these drawings. So let's do 2 examples just to make sure we really understand it. So this is the volume imbalance here. And this is a volume imbalance here. What a volume imbalance is the separation between 2 bodies. So essentially it's missing volume because most of the volume is held in the bodies of the candles. So if there's no bodies that overlap a range, it's going to be considered a volume imbalance. So when we see here, this candle closes and this candle opens, that separation between those bodies, that's what we label our volume imbalance. And you can use it several ways. It can be used as an entry. It can be used as a target. It can be used as a means of reading order flow, like I did this week live, because the fact that we couldn't even trade down into that volume imbalance, that indicates what? It's really strong. Because what are the 2 things this market is designed to do? Seek liquidity and balance inefficiencies. If the market's giving you feedback that it's unwilling to even rebalance an inefficiency, it's indicating it's extremely bullish. It's very strong. So the same way like we use breakaway fair value gaps, you can use a volume imbalance the same way. So as I was saying, they can be used as targets, as entries, as means of reading order flow, as a means of seeing order flow shifting, right? Because if we break down through that volume imbalance, now that's not as bullish as I was initially thinking. So that's how you're able to have this information, understand how to pivot when you know how to read it. And the same thing here, we see another volume imbalance, right? You can see how much it's wanting to work that level here. Now, perfect example. You see this volume imbalance here, how it trades into it once, twice, 3 times, 4 times. Is this a market that's in a hurry to go anywhere quickly? No, right? Because it's spending a lot of time inside this imbalance. Compare that to this delivery here. Do we spend a lot of time in the volume imbalance? No, it can't even hit it. So what does that confirm to you? It's extremely bullish. And then you can see in the details, you're able to see why is it going to consolidate here? Because it's spending too much time in the gaps. Why is this going to be one-sided straight shot higher? Because it's confirming it's extremely bullish with these signatures here. So again, as always, the precision is in the details. Great question. Unicorn, on the daily, do you use the first bearish candle as the order block? Do you not use the 2 bearish candles as the full order block, or it depends on how big the candle is? Another excellent question. Let's take a look. So everything's all about refining to the time frames, right? So if we go look at the same range here, right? If we look at the same range here on the weekly time frame, let me take these levels off. This is the order block on the weekly chart here, right? This down close candle. So I would use this as the order block here. But when we go down to the daily, what do we know? Every higher time frame order block will be on the lower time frame. Every higher time frame order block is going to be a lower time frame bullish breaker. So what I would look at for my analysis is I would understand, okay, this is an order block on the weekly, on the higher time frame. But when we zoom in, we want more precision. We want a more refined range. So how do we refine that range? I'm going to use the breaker here. Low, lower low, the highest up close candle in that range. And then you'll see that's what makes the low and we rally higher from. When zooming in, technically, the entire weekly order block would be this range here, right? So technically, you're right, with this entire down close being the range of the order block. Let me put that on the weekly chart. Right, so we can see now here on the daily chart, yes, you're right. The 2 down close candles would be the order block on the daily chart. However, to refine it throughout the time frames, if this is the order block on the weekly chart, I can refine that to the daily chart to this last down close here. And then I'll use this range on the daily chart. So it essentially depends on what time frame I'm analyzing. If I'm looking at the weekly, then I use that entire range. But as I zoom into the daily chart, I want more precision elements. I want to see the low here, right? I want to see the breaker. So I'll just refine it to the last down close on the daily chart, right? So if we go into like a 1 hour, let me see. Yeah, so if we refine down to a 1 hour, we'll see these are the consecutive down close candles that creates the order block. And then you can get really precise as you zoom in through the time frames. But it's all essentially dependent on the time frame that you're analyzing. Howie answered your question. Thank you, sir. Islam, days with no news like Monday and Friday this week. The algorithm will refer to fair value, or this only happens on Mondays? Every time there's a consolidation profile, we expect the market to refer to fair value. If you think about it logically, if the market's not expanding, it's doing what? And this can go directly in your notes. If the market's not expanding, it's consolidating. If the market's consolidating, it's going to refer to very specific levels. I define those levels as fair value. What is fair value? The opening price. Midnight open, 9:30 open, the new week opening gap, where we close on Friday, where we open on Sunday. The regular trading hours gap, where we close on Friday, where we open Monday morning. Those are all reference points that will be considered fair value. And if you think about it, it makes sense, right? Because in an expansion profile, the market's going to open, make a low of the week, expand, and then close off that high. So that's an expansion week. But in a consolidation day, the market's going to do what? Stay in the range. So if it's going to stay in the range, there's still precision elements in that because it's referring to levels that we would consider fair value, which again is the levels I defined. And as long as you know what you're looking for on those days. So if your analysis doesn't call for an expansion and it calls for a consolidation, the market's going to consolidate and it's going to refer to fair value and equilibrium. Equilibrium meaning this range here, which you'll notice on consolidation days, if you study them, they do what? They trade to the extreme, pull back into the range. Trade to the extreme, pull back into the range. Trade to the extreme, pull back into the range. So there's still precision elements on consolidation days. You just have to know what you're looking for. Phenomenal question. So it's not just Mondays. Anytime your analysis calls for a consolidation, that's what you look for, fair value. Bags, does NQ give a better price delivery than S&P? I think so, yes. S&P is a bit cleaner, a bit more tame. NASDAQ's a lot faster of a market. So there's several things you can do with that information. Like if you still want to trade the S&P, like I've done this many times where I'll trade S&P, but I'll use a NASDAQ entry, right? Because the imbalances, the delivery is a lot cleaner on the NASDAQ as opposed to S&P. Let me go and show you what I'm referring to. NFP is probably not a great day, but. So what you'll notice on NASDAQ is the imbalances generally are more clean, easy to see. It creates more imbalances and it's easier to see these key levels on the NASDAQ as opposed to S&P. But what you can do, if you know where the market's drawing to for S&P and NASDAQ, you can watch the NASDAQ, see that, okay, this is the ideal entry here in NASDAQ to go higher. And then you can use that just to buy S&P because they're generally going to move in sync unless the markets are decoupled. But that is a whole nother conversation in and of itself. So generally, yes, the NASDAQ will be a bit cleaner, a bit faster, but there's nothing wrong with S&P. I got profitable trading the S&P, and then I moved over to NASDAQ as it started to just be much cleaner in the past few years. Cyclops, solid information, Dylan. Give the stream a like, guys. Appreciate you, brother. Thank you very much. Bazooka, breaking or close? I'm not sure what you're asking, brother. Ian, hey Dylan, love your analysis as always. Does your paid Discord members get access to live trading? Yes, sir. Yes, sir. In the Discord, live trading is something that you guys have access to. That's one of the several benefits of having the community. However, it is something that we are looking to close off for newer members going forward, because I've got bigger and better things that I'm going to do to help out those that want to learn and get successful, but can't say too much on that now. But we will likely be closing the doors on it soon. The community's not going anywhere. Those of you guys that are still in it, consider yourself lucky. You will stay there. Nothing's stopping. Nothing's closing up business. In fact, we're doing a whole lot more and growing much, much more. So with that in mind, an update there. We'll have more updates as we go forward into the next week or so. And lastly, before I get going, we will be live every Sunday starting at 2 p.m. going into 2025. So I know last year many of you guys had alarms set. Many of you guys were ready to go here on Sunday. Do the same next year. We will be live every single Sunday covering what opportunities we're looking for, confirming it with an institutional perspective, with intermarket analysis, and as always, giving you guys the best of the best here for free. So with that in mind, guys, make sure you got your alarm set. I will be seeing you guys for the remainder of the next year. Bazooka, talking about breaking a level. Do you mean closing or wick also counts as breaking? Good question. Generally, a close will be more significant, right? Like if we close below a key level, that's a lot more decisive than a wick trading outside of it. But both are significant. It really just depends on the context. I know that that's not like a firm answer. But let me explain to you what I mean by that. Right, like for example here, last week I shared within the free Discord, which is free. You guys can still join the Discord. We're giving education daily. It is free. I share analysis in there time to time. And sometimes my analysts take 1 or 2 days out of their week while they're trading to share targets and call it. And it speaks for itself. It's absolutely money. But back to the question with the weekly fair value gap here, right? Look at this blue rectangle. That's a weekly fair value gap. One of the things that I was looking at last week is if we're going to remain bullish, we should find support inside the weekly fair value gap. However, what do we do here? Well, technically we broke it to the downside, but it only did it with the wick, meaning it traded to the low end, colored outside the lines a little bit. That's permissible, and it quickly leaves it. So technically it broke it, but I don't consider it breaking down through it. Now, if we would have closed below it, hit the high end as resistance, then broke down, now that's something I would consider much more decisive. That would be a much stronger break of that key level and then confirm bearishness. So you see how it really just depends on context to confirm break or a close above. Because there are times when if it just wicks through it, that's enough for me to look for bearishness. Like same thing with the market structure shift. I don't need to see a close above for a market structure shift. Just the market trading through that high is enough. But if it closes above, then that's even more significant. So it's just about weighing it out and using experience, leaning on that. Hopefully that makes sense. Mr. Nuller, what's your view on gold? It's stuck between two fair value gaps and it's consolidating. Do you think it's still bullish long-term? Absolutely. Yeah, long-term gold is absolutely bullish. I am not a proponent of trading gold. I think it sucks to trade. But if we zoom out long-term, I'm absolutely bullish on gold. You look at the weekly chart. Yeah, just really sloppy. And then dropping down to the daily, as you mentioned, we're just trapped between this fair value gap here and this fair value gap here. So while we have that trapped order flow, it's going to be very low probability until we break the range higher or lower. And not in the sense that I'm a breakout trader, like if we trade higher, I'm buying the breakout, but we want to see it leave that range. Because as long as we remain in here, it's difficult to justify what? High probability. What's high probability? One-sidedness in the marketplace, right? And there is no, all right, it's going lower because all these factors and there's hardly anything to say why it can't go higher, right? In this case, we don't have that. So it's low probability by the way I look at the markets. So yeah, we're in a consolidation for gold in the near term. A lot going on in the world that gold's waiting for with the BRICS nations. I'm trying to think of how I want to say it. A lot of things going on in the world. BRICS nations with their new currency that they're looking to make it gold backed. the wars in Middle East. I got to be really careful because if I say things, YouTube will flag it. But yeah, just a lot of geopolitical turmoil making gold really difficult to predict in the short term. There you go. Unicorn Queen. Okay, thanks. That helped a lot. Awesome. Glad to hear that. Reaper. BPR is fair value too. Yeah, balanced price range could be considered fair value because the balanced price range is many times a fair value gap, right? So it's in the name, fair value gap. The market's trading to fair value. Dylan, the Dow being garbage is fighting words for some. Yeah, that's cool, man. Everyone's got their ways of making money. I don't shit on anyone else. If you're making money with the Dow, man, you keep doing what you're doing. If you're making money, man, you don't even care what I'm saying anyway, right? Bags, I appreciate that. Thank you. Yes, sir. Yes, sir. Thanks, Dylan. If the market were to reverse on NASDAQ and reach for the relatively equal lows, what would you need to see to confirm a full-on reversal rather than a short-term retracement? Great question. All right, so we're going to look at this daily order block here, top down. So we're going to look at it as we drop it in the lower time frames. All right, let's say from open, we break down aggressively. There's several things that I read into with institutional order flow that help me confirm or invalidate what I'm looking for. For example, what allowed me to be really bullish this week, and these were things we were all covering live Monday going into Tuesday. Look at this down here. It trades higher. Well, first we do what? We drop lower, take out the sell stops. Before any significant price run, you're going to see a stop run in the opposing direction. Once we run the stops, what happens? We displace and break higher. What do we do on that displacement? We create 1, 2, 3 fair value gaps on the upside. Well, no, 2. 1, 2 fair value gaps on the upside. What allowed me to trust that this thing was not only bullish, but it's extremely bullish? Well, keep in mind what I already shared on the monthly, the weekly, and the daily. But now look at how the hourly further confirms it. You see this fair value gap down here? Had no interest in filling it in. Couldn't even fill in the upper fair value gap here. See how it stays in the upper portion? What's that telling you as a smart money trader? It's extremely bullish because why? It can't even rebalance this inefficiency here or here. And then what do we see right here? We have a fair value gap. Does it show any interest in wanting to fill it in all the way? No, right? This is how we were able to call the low of the day this Tuesday, call it higher into these highs with all these factors here. So why am I explaining that? Because if I'm going to give you a good answer, I got to give you the context for it. So what would allow me to trust this thing's really breaking down? Let's drop down to a 15-minute. A retracement would just be the market dropping down into this level to continue higher, right? However, a retracement is not likely going to be fast, violent, and displaced. It's likely going to retrace slowly and then be low resistance on the upside. However, what would confirm to me it's really bearish and we're going to run to attack these lows? If we start breaking down, leaving a breakaway gap, we can't fill it. It gives signatures that we look for bearish order flow. All PD arrays, we can't trade up to the upper portion, whether it be a fair value gap, order block. If we have all those factors confirming that, then that would be extremely bearish and allow me to trust that we're going to trade into these lows. So what would that look like? Well, retracement would be, a lot of back and forth, dropping down into a discount, then quickly displacing higher. If it's really going to sell off, then it'll likely bump the highs, aggressively displace lower, retrace, and keep smashing lower. In the process, it'll leave breakaway gaps, imbalances, and it'll leave you signatures that's going to confirm it's really weak. So you see all the things it requires to read into to see when the market's shifting, when it isn't. But once you know how to read order flow, once you know how to read the markets, no one can take it away from you. So definitely invest in learning how to read price action, and you'll know when it's going to continue or when it's going to reverse. And when I say no, there's never a guarantee. It's all based off probabilities, right? So you can put the probabilities of your trades through the roof if you understand how to read price action at an advanced level. So that's signatures that I would look for to confirm if it is going to attack the lows, or if it remains bullish, then it will show other signatures. It's just a matter of knowing how to read the institutional order flow. Yeah, good question. Really good question. Jang Plays, awesome analysis, my brother. Thank you, my man. Kelvin, love today's Q&A. Thanks. My absolute pleasure. Appreciate you joining. Mr. Nuller, okay, thanks. I'll sit on my hands until a breakout happens. Yeah, definitely. It's easy to, like, if we look, going back to gold, it's really easy in this type of price action to dust accounts if we're not careful, right? Because naturally we're looking for the liquidity, right? So imagine going long here, expecting these highs, and it smashes back down into the range. Imagine looking for these lows here, pulls back into the range. So it's really difficult to navigate this type of price action unless you just have a lot of experience to be able to do it. So, I mean, it is tradable, trading these little ranges here, like same thing we had in NASDAQ a couple weeks ago going into the holiday week. I mean, it's very tradable. Like myself, my team were able to find profitability in this, but it's just because we have years of experience to lean on, but it's not easy. So one of the things that I always teach is everything we're doing is probabilities, right? So when you want to strike, when you want to attack is when the probabilities are in your favor, right? As opposed to out of your favor, right? So you want to find market conditions that align with your edge, your strategy. And if you recognize that, okay, these market conditions aren't high probability for my edge, then we have to sit still. We have to wait until we can get those cleaner market conditions if we want to have long-term consistency, right? And when I mean long-term consistency, not just a payout here and there, you know, luckily once a year. I mean consistent, making money month over month. And that's a skill set you learn with all the things that I share here, right? High probability, understanding when it is, when it isn't, right? And how those factors shift in and out of the marketplace. But it's one thing to know that. It's a whole nother thing to be disciplined and understand that, okay, it's not my day. Let me just be patient, be disciplined, and wait till the next day, right? That's the hard part. Bisrat, can we see the Dow? Yeah, let's take a look at the Dow. We have sell side here, but right now we remain in a range. So we have these relatively equal lows, and then we have these relatively equal highs. So I assume they're going to want to do something with these highs here, but since we traded higher, we bumped the highs. We failed to displace above it, broke down. I'm looking for, well, that sell side they already delivered. So what you'll want to do is take this wick, split it in half. Look for midpoint of that wick. And then if we start to accelerate through that and slide down, then we have the low there. That's all I can say on Dow. I don't have a lot of clarity on Dow because of how it's trading. Eslam, thanks for the insight. Much appreciated. Thank you for joining, sir. Yes, sir. Humble investment. What is your top indices you trade daily? NASDAQ. NASDAQ's when I trade. I will trade S&P, but most of the time I am trading NASDAQ. Would this V formation on NQ, with the series of down closed candles and the series of up closed candles on the daily, be considered a daily balanced price range? Yeah, absolutely. Right, this low here. And let me change the color on this to here. This is all a balanced price range here. Why? Because we did what? We traded higher, right? So we had one pass higher, one pass lower, and then higher. So this entire range has had what effectively done? Buy side delivery, sell side delivery, and then we left that range. So whenever we have that is past both sides, higher, lower, and then we leave that range to the upside, that becomes a balanced price range. That's why breakers are so effective, right? It's the same logic here. Here we did what? We traded higher, lower, and then higher again. We left that range to the upside. So what does this all become here? A balanced price range, right? So it trades into it. You see how it's really hard for it to get down through the balanced price range? So when we're trading through a balanced price range, that's when you're going to have a high resistance liquidity run. And that's why we saw that type of price delivery in the early weeks of November. But yeah, that's a balanced price range. A lot of insight you get from understanding the difference between an efficiently delivered range and inefficiently delivered range. Great question. Justice, thanks, Dylan. I'm getting my mega payout with Funded Next tomorrow. Thank you so much. Free content is gold. My man. Really happy to hear that, Justice. Keep up the awesome work, and it's my absolute pleasure to have played a small role in your development, my man. Keep it up. Awesome. Michael, thanks. So clear explanation. I appreciate it. I appreciate it. Howie, great session. Thank you. My pleasure. Unicorn Queen, during the trading session, like 9:30 to 4, how often do you look at the higher time frame? Do you refer to the 1 hour each hour to see that candle close? Absolutely. So when I am trading, I always have the daily, the hourly open for NASDAQ and S&P, and I'm looking at the 15, 5, and 1 minute. So I'm constantly cycling through all those time frames as I'm trading because of the information it provides me. Absolutely. I want to see what the daily chart, I want to see what the hourly chart, because they don't change a lot, right? The daily chart, is the daily chart. The hourly chart is the hourly chart. It takes an hour to form each new candle. So it's not like I'm having to look at it every second, but I do have that information displayed because I absolutely want to see how the hourly candlestick is forming for power of 3, how the daily candlestick is forming, and all that insight comes together to give you precision. Absolutely. On point as always, looking forward to every Sunday again in 2025. Looking forward to it as well. Absolutely. Reaper, before you go, can you take a look at EU or GU? Yeah, let's take a look at Euro. I promised you guys I'd take a look at it. All right, so I said I'd share something on relative strength analysis. All right, for example, like if we look at currency, what have we seen? Higher dollar. Bullish dollar means what for foreign currency? It means lower foreign currency, right? So we've seen euro selling off and pound selling off. But what you'll notice is look at the difference in pound and look at the difference in euro. Euro cleared all these lows here and here. Yes, pound sold off, but it didn't take out this low here, or this low here, right? Whereas the Dow did all, or the Dow, been trading too much index futures. Whereas euro took out all those levels here to the downside. Many may look at that after the fact and see, well, that's really nice to know after the fact, but how could I have predicted that? That's what I was mentioning earlier with relative strength analysis. So if you really want precision elements in your trading for foreign currency, it's not enough to just hear me say, all right, dollar's going higher, short your foreign currency. Certain currencies are going to be better to short than others. How did I know, or how could you have anticipated euro being weaker than pound? Well, you want to go to the cross with euro pound. And what do we see here with euro pound? It's trending lower, right? It's showing bearish institutional order flow. Which name is first here? Euro is first. So because it's weaker, because it's selling off, and euro's first in the name, that means the euro is weaker versus the pound. So if you're taking short setups, you want to short euro. If you're taking longs, you want to long the pound because of the relative strength analysis. And there's a lot of other details I could get into, like the institutional order flow, the signatures in that, the breakaway gaps, how it couldn't even trade up to the wick. There's a lot of other signatures in here that I could easily turn this into a 2-hour long teaching, but that's not necessary. That's more than enough to allow you guys that trade currency to hit the ground running. So it's not enough to just see dollars bullish. You want to confirm it with what you're looking for with the relative strength analysis. Daniel, we having Sunday live session next week as well? Next year as well. Yes, sir. All next year, I'll be here on YouTube with you guys. Absolutely. Humble investment. How do you prepare to face? Really good question. So how do you prepare to face consistent losses, emotional challenges, self-doubt while maintaining discipline and sticking to your trading plan without chasing profits? Question of the year right there. Phenomenal. So one of the biggest things is, how do you face all that, right? Consistent losses, the emotional challenges that you go through, losing money, making money, the stress it puts you through. And not only do you have to endure that, but now you have to conquer self-doubt. You have to, during that whole process, also stay disciplined, follow your plan, right? Not chase profits. And that's one of the most difficult things to do. One of the things I always say is you have to have a big enough why. Because if your why isn't big enough, the pressure that this industry will put you through will crush you psychologically and mentally. And it will chew you up and spit you out if you're not psychologically prepared to endure this. So what I say is you absolutely have to have a big why. If your why is not big enough, then you will absolutely fold under the pressure that this will put you through. On top of that, you need to understand that your trading plan is the key to get through that. So what do I mean by that? If you deeply understand that your trading plan, your model will get you to your end goal, it's much easier to stick to it. But if you have doubt about your trading plan, maybe you're not even using a trading plan, right? Maybe you don't have structure. Maybe you don't have a model that you trust. And if you don't have all those factors, then it's going to be impossible to win. You almost lost the game before you even started. So number one, have a big why. Keep it front and center. Number two, make sure you are doing, or make sure you have a process that's rooted in sound logic, right? You know how to read price action, right? You have a model. You have back tested it. You have a trading plan. And then as you trust that, it's going to be easier to stick with it throughout the adversities and the difficulties that you go through in your trading. Great question. Reaper, thanks, Dylan. Learning something new? Love to hear it. Love to hear it. If you're learning something new every time you're live with me, then that means I'm doing my job. So with that, guys, phenomenal session. Be sure to hit that like button on your way out if I was able to help you out, if you're able to get some value here from today's session. I will now be signing off. We're going on 3 o'clock. Got some other matters to attend to here before we start the new week. With that, guys, big thank you for all you guys for joining us. Really appreciate it. I will see you guys on the next one. Now to see what we're doing. Maybe we'll do some live tape reading during the New York session live here one of these days. Let me know. Maybe if you guys get it up to 100 likes, that's something I'll look to do here this week, or if not, the next. Do some live tape reading with you guys. So with that, folks, have a lovely rest of your weekend. I will see you guys in the next one. Take care. See you, Justice. See you, Islam. Take care, guys. Man, I can't go without that question. Islam, how do you trust your model without fear of being wrong? Great question. You have to demo trade it, right? Because if you haven't gotten the reps with your model and you just start trading it with live money, of course it's going to be fearful, right? Of course you're going to have anxiety. Of course you're going to be stressed out because you're a doctor, you're a surgeon that's doing surgery and they're through their second year of college. So you're a sophomore in college and you're trying to cut on a live human being. And that's essentially the equivalence of trading before you're actually ready to. So if you actually learn correctly, you learn how to read price action. There's a process you have to go through. Number one is learning how to read price action. From there, you have to develop a model. That's step number 2. Step number 3 is then building a trading plan and testing that model going forward. And with those 3 things, you won't be fearful. You'll know what you're doing. You'll know why you're doing it. You'll be able to take losses and not fear that, man, this isn't working for me. It's never going to work. And you're going to have the confidence to know what you're doing and why you're doing it. Have a great weekend, guys. Take care.